take the example of stablecoins, that crypto crash and the UST crash has simultaneously educated the existing crypto market and all the investors.
In this interview, Michael Saylor talked about his new predictions for stablecoins and why he thinks Bitcoin is superior than other cryptos. He then went on to talk about the institutional investors and the big banks and what he thinks they'll do next. He then made a not so unexpected prediction, saying that the crypto market can have a total market cap of $100 trillion, and he also laid out his reasons behind this prediction. He talked about inflation and how it's affecting the market and a lot more. If you want to hear Michael Saylor's comments on the crypto market and more about his current holdings, then watch this video all the way to the finish, and don't forget to press the like button. Also subscribe to our channel for daily videos on finance and investing. We post twice every single day. Now, let's look at his interview.
If you look at the entire crypto universe, you have a lot of different creatures. You have crypto commodities, you have crypto securities, you have crypto exchanges, you have cryptocurrencies. And then you have a set of applications and protocols that interlace with all of these instruments. And what you have is a bunch of people in the ecosystem that don't necessarily understand or have the information to make the best decisions. And you have a lot of people outside of the ecosystem that are afraid to enter the ecosystem because they don't have the clarity they need. So for example, what's a currency? Well, a stable coin is a currency. In theory, if I can move $1 million from me to you without incurring a tax bill, that looks like a currency, a stable euro, a stable yen, a stable dollar. There's a huge amount of demand for it. It's probably $1 trillion to $5 trillion of demand for it. Everybody wants it. However, you have 3 different types of stable coins off the top of your head. You could have stable coins that are backed one for one with dollars, and they look fairly secure. You could have if you saw $10 billion of that stable coin with $10 billion of currency equivalents backing it, or cash equivalents backing it, then that's something that you probably could trust and put a lot of weight on. There's another set of stable coins that are backed by something. Let's say maybe they're backed by equities or they're backed by debt. And maybe I build a stable coin with $10 billion of junk bonds backing it. Not quite as, and the $10 billion of junk bond, maybe I have $10 billion of real estate backing a stable coin. They're not liquid. They're not mark to market. It's still something tangible, less tangible. And then the third stable coin would be, I just issued $10 billion of stable coins with nothing backing. They're all quote unquote stable coins. But one of them, like UST, collapsed to zero because it literally didn't have anything backing it, or maybe the backing was 5%. It might have been back 5 or 10%. I don't think they had $18 billion worth of cash equivalents. So they probably didn't have $18 billion of real estate or junk bonds backing when they got to 18 billion. They had $18 billion worth of Luna, right? And so what you have there was something highly risky, but not perceived as risky because there's not really clear disclosures. And if you'd asked 1,000 people, what's the difference between UST and Tether and Circle, they couldn't tell you. Right? But that would be the three examples, right? Sort of Tether's in the middle, Circle's on one extreme, UST's on the other side. So this crash is going to cause a lot of clarity to form there. First, the community is getting educated, right? I bet you everybody in the crypto community today knows the difference between a dollar in the bank and UST. And I bet you they have an intelligent conversation about the difference between Circle and UST and the business model of the two. And we saw last week, Tether had to redeem billions and billions of dollars of Tether, and they could, right? So they could. But if you had actually, tried to redeem $7 billion of UST in a couple of days, well, people tried to do that and they couldn't. So I think the industry got educated, but also I think that there's a lot of people that would like to issue stable coins, like Caitlin Long's bank would like to issue stable coins. And if you look at the banks like Silvergate and Signature, they're FDIC insured banks, but they can't issue stable coins. So, and if you look at JP Morgan and Goldman Sachs and Citigroup, they can't issue stablecoin. Now, if you roll the clock back 6 months, the president's working group put out a memo on stablecoins. And when they put out the memo, they said, we'd like for FDIC institutions to issue stablecoin. Now, putting aside whether you agree with that or not, there's been a regulatory deadlock on Capitol Hill, because in the 6 months after they put out that memo saying they think that banks should issue stablecoins, no bank issued a stablecoin. And that's because the president's working group memo said, well, Congress should pass the law making this clear. And until then, we'll think of it this way. So the banks are waiting for Congress to pass the law. Congress didn't pass the law. And all the way up until last month, there's really no clear consensus to move on this. And we didn't expect any clear legislation or regulation before 2023 or 2024. So I think that if we just take the example of stablecoins, that crypto crash and the UST crash has simultaneously educated the existing crypto market and all the investors. It's also introduced, the concept of risk. There are different, not everything is equal, right? There are 19,500 things, on coin market cap, but they're not all equal. So to say, well, this is risk-free or that is, they all have different flavors of risk, but how do you assess the risk? Mm-hmm. So I think that the industry is getting more sophisticated. I think that the regulators now have some pressure. The Secretary of the Treasury was in a congressional hearing with Senator Toomey, and he's been an advocate of some stablecoin legislation. And he asked her, you think we need to get it done this year? And she said, yeah, I think we can and should get it done this year. So the consensus among the regulators and the politicians is, yeah, we probably need to do this. Now, you could say, if you're the crypto anarchist, I hate regulators, I don't want them to do anything. Well, that's one way to view it. But as long as they don't do anything, the industry stays $1 trillion, mm-hmm. $1, $2, $3 trillion. When they do something, then you're going to see people like, let's say David Solomon was on CNBC last week. He's the CEO of Goldman Sachs. Well, whatever Goldman Sachs thinks is probably what JP Morgan thinks and Citigroup thinks and Bank of America thinks and Wells Fargo thinks. So what he says is, yeah, we know the crypto economy's here to stay. We can't custody it yet. We're afraid to custody these assets. Like we're not allowed. His actual words were, "We're not allowed to."
Right.
And if I speak to CEOs of publicly traded companies and banks, like publicly traded banks, they'll say, our regulators won't let us. So you see the conundrum here, which is you can either stay in a regulatory gray zone where there's about 1% of the money. You can be 1 or 2% of what you're going to be, and you can stay in the gray zone. Or you can create a clear public policy framework, and then you move into this compliant zone. And when Goldman Sachs and JP Morgan enter the space, they'll issue $500 billion of stable coin, trillions of dollars. And so you'll go from 150 billion to 1.5 trillion. And when they start issuing in that size, you'll see Amazon and Google and Microsoft using stable coin for international remittance and corporate remittance. And then you'll see it get built into Apple Pay and Google Pay and Amazon as payment method, right? And then you will actually see billions of people using this stuff instead of hundreds of millions or tens of millions. So I think that the consensus is the regulators need to provide more clarity on this issue of stable coins, and they also need to provide more clarity on the requirements for a crypto security. Right? It's clear that Luna was a crypto security. The reason it's a security is there's an issuer and there's someone that can make decisions. And if I can actually make decisions, if I can take $3 billion and buy Bitcoin, and then I can take the same Bitcoin and sell it on behalf of the people that own the Luna token or on behalf of the people that own the UST token, I'm acting, kind of like a public company officer, like, and if you're a public company, like think about MicroStrategy. Like if I just sold all of MicroStrategy's Bitcoin and I didn't tell you, right? Or if I bought twice as much and I didn't tell you, I would be changing the nature of the security. I have, kind of an obligation to disclose that, an ethical obligation as well as a legal obligation to disclose what I'm doing when I can actually impact the value of the securities held by the public. So I think that this is going to accelerate that regulation. It'll accelerate the regulation of the crypto securities, and which are many of them are unregistered securities, and there's no disclosure. It'll accelerate the regulation of the exchanges. It'll accelerate the regulation of the stable coin. And in the near term, there'll be a shakeout. So, some things, when you look at them in the light of day, you'll say, for example, what's a shakeout? I decide I like Circle better than I like UST. That's a shakeout, right? Right. And it'll also create an on-ramp for institutional intervention, because you've got $300 trillion worth of money, that's $100 trillion of bonds, $100 trillion of equities, $90 trillion of currency derivatives, all sorts of forms of money. You've got other sorts of derivatives. They're all sitting out in the mainstream economy.